Hello, welcome to this section where we are going to understand the accounting cycle, or basically the accounting process, where we are able to see from being able to identify a transaction as it happens, being able to record these transactions, summarize this transaction until at the end of a certain accounting period, we are able to formulate or come up with the financial statement, which is basically showing which is basically showing a summary of the financial transactions that has happened during a certain accounting period. Okay, so let us start from the first thing that we do, which is identifying a transaction. An accountant needs to identify a financial transaction as it happened. And how do you know this is a financial transaction? You are able to quantify this transaction. You are able to quantify this transaction. That means you're able to say, let's say, for example, we've bought cabs worth 10,000. We've bought cabs worth 20,000. Okay. We have sold cabs worth 20,000, or we have bought a laptop worth this amount of money. So we should be able to quantify that transaction that has happened and be able as well to tie this transaction to a supporting documentation. What do we mean by a supporting documentation? We are able to see, for example, an invoice, a receipt, a goods delivery note, a delivery note. Okay, those are supporting documentations to a transaction. Whatever, let's say, for example, you've bought a laptop, you've been given maybe a receipt, you've been given maybe a delivery note if they brought it, you've also issued a good delivery note, okay, a goods receipt note, okay. So such are what we call supporting documentation. So we need to trace this transaction to a supporting documentation as well. You're going to see this is very key, especially when we are also bringing in an external auditor to check our financial statement. They also look at the transactions and they want to see that they can trace this in the supporting documentation. Okay, so after that, after identifying the transaction, what happens? We do record this transaction by passing something we call a journal entry. And a journal entry uses a set of tools called debit and credit. We use debit and credit to record transaction. Remember, I mentioned earlier, a transaction involves at least two parties. At least two parties. So there is always going to be a debit and a credit on the other end. Okay, there is an inflow and an outflow somewhere else. Okay, so we need to be, we usually record this transaction using the debit and credit tool. Okay, we are going to look at this further in module 2, that is a double entry accounting system. Okay, so once we do that, once we record every transaction by passing this journal entry, that is a debit and a credit, we come and summarize that in a ledger. The ledger is basically a summary for each account. For each account we can pull the debits and credits that have been passed on these accounts. So we are able to see the balance at the end of the period. We can see the movement during the period. Okay, so the ledger basically summarizes, let's say if you had as a debit on the cash account this amount, you add a credit later in that cash account, maybe another debit and another debit. So at the end, this cash account, we are able to see individually as a cash account what are the balances and the movements during that period. Okay, so the ledger basically does the summary, and then from that we have been able now to summarize them into we can be able to pull, we can filter per account, the transactions per account in the ledger. Okay, so what does the trial balance do? The trial balance now, it shows us the balances of each account, as at a given point in time. Okay, we are saying, for example, as at 31st December 2025, this is the cash balance. This is the cash balance in the cash account. So the trial balance gives us the balances, that the balances as at a particular point in time. And this this accounting report, that is a trial balance, is very key to the institution because it relies, the business relies on it to prepare the financial statements. Also, the external auditor relies on it to audit the transactions that are there because they're able to see the balances that are there as at a particular point in time and be able to look back and see which would and trace their test work to specific transactions that they want to test depending on their materiality. Okay, then we have period and adjusting entries. This is brought about mostly because of the use of accrual method. Okay, the accrual method expects us to make sure, that is the accrual method and also the matching concept. Okay, we need to make sure we do the period end, as at the end of a certain accounting period we need to look at the depreciation, we need to look at the accruals and the prepayments and make sure we do the necessary adjustment as at that period end. We also need to look at the inventory closing balances. We need to look at the allowance for bad debts. Okay, so they are usually those period end adjusting entries that happen only at the end. And now these are the ones that they are passed also via a journal. Okay, and then they come back to now we are able to get an adjusted trial balance after passing this period end adjusting entries. Okay, here again, also in case there is any error that has been noted, also we do adjusting entries to correct errors. Okay, so in case there is anything that was not balanced, we do that. We do the correction of these errors. In case there was anything that was omitted, all this is done here at the adjusting entries. Okay, so then we are able to get the adjusted trial balance. Those are the balances as at a particular point in time. Okay, with inclusive of the period and adjusting entries, and we are able to see the debits accounts and the credits accounts. Okay, which we shall look further in the module 2, that is the double entry system. Okay, we are going to understand how these accounts are classified. Okay, so once we have this adjusted trial balance, we shall be able now to formulate the financial statements. Okay, the financial statements are those statements that are prepared in that even the external person looking at a company or a business, they are able to see how is the bank, how is that, for example, the bank, how is the bank performing, how is this business performing, especially for public the companies that are listed in a stock exchange. We want to see how the investors want to see how is that company performing, so that they know if they need to buy shares there or they sell, or what is happening there, so that they know what the move that they should take. Okay, now let us look at the key financial statements that are usually prepared. Okay, and number 1 is the statement of financial position, which was commonly known as the balance sheet. Okay, this shows the balances of as at a particular point in time. It will show the balances, the assets in that business, the liabilities and equity in the business. Okay, so the balance as at a particular point in time. Okay, then the statement of profit or loss as is it state, and usually and other comprehensive income, if there is any other comprehensive income in the business. This one shows it is able to show us the revenue that has been earned during the period and the expenses that have been incurred. And then from it, once we less the expenses from the revenue, we are able to see if a business made profit or loss. Okay, so that is a statement of profit or loss. Then we have the statement of changes in equity. Remember, equity is owners' interest in the business. So this statement usually show how the movement of capital contributions during the period, any dividends that has been paid during the period. You're going to understand share capital. There is share capital, there is share premium. Okay, so this basically it just shows the structure in terms of equity, in terms of owners' interest in the business. This specifically is for the owners' how the shares are, especially for public listed companies. They want to the business present this to show how are people, the shareholders movement, or is there any share capital that has come in, or what has been happening during the period. Okay, then we have, in terms of equity, then we have the statement of cash flows. The statement of cash flow, it shows the cash flow movement in operating activities, in financing activities, and in investing activities. That is the usage. How has cash been coming in and cash outflow, depending on the activities that are happening in a business. Okay, so this one is going to show the liquidity. Also, it's going to show the cash, where is cash being used more, where is cash being generated from in the business, whether in investing, financing, or operating. Okay, so that is the statement of cash flow. This we are going to look in the module 4, that is financial statements. We are going to look at the financial statement for different types of different types of businesses, that is sole proprietorship, partnership, companies. Okay, manufacturing companies as well, and also not-for-profit organizations. Okay, so then after that, after a business formulates these financial statement, if it is a company that requires an audit to be done by law, as per requirement of law, then an external auditor comes in, does the test work they need to do, and then they give they say if this is a true and fair representation of what the company is reporting, then this is what is published at the state as a financial statement during that accounting period. Okay, and as at the end of the period, the company also does the closing entries, that is closing the temporary accounts. Okay, and for example, like retained earnings, we say what is the closing balance of the retained earnings. We close the temporary accounts of revenue and expenses. Okay, so that we have a proper opening balance in the next accounting periods. Okay, so that is basically the accounting cycle. And now that we have in this module, we've got to understand the fundamentals of financial accounting. In the next module, we will be looking at the journal entries. How do we know when to debit, when to credit? Okay, we are going to look at how the ledgers summarize this per account. We are going to look at the trial balance. Okay, we are going to look at the trial balance and how we come up with the trial balance. Okay, so you are going to find these in module. You're going to find this in module 2. That is basically the double entry, because here we use the double entry accounting system. That is the principle behind it is the accounting equation. Okay, then the period end adjustment, you're going to look at a whole module. That is module 3, where we shall be looking at period end adjusting entries. These are many. You're going to see we usually have accruals, we have the prepayments, we have the depreciation, we have allowances for expected credit losses, we have provisions. All these we will cover this in module 3. Okay, and also the adjusted trial balance. After now doing the period end adjusting entries, then how do we come up with the adjusted trial balance? Okay, then in module 4 now is where we shall look at individual financial statements. Okay, so with this, in the next section, let us look at a quiz to summarize what we've learned under the financial accounting fundamentals. It is very key for us to be able to understand the next module, which is the double entry accounting system, which is where we are going now to learn when to debit, when to credit, the classification of accounts, the trial balance. These are also very key, but you need to understand these on the overview and understand the basic things behind that system, which includes the double entry, the accounting equation, And also being able to, from it is where we come up with the double entry system, and also being able to understand what are assets, liabilities, and equity. Okay, so in the next section, do the quiz to see if you have understood what we've learned in this whole module. Okay, see you in the next module.